Let's get some common sense about the Fed from Craig Bolanos, the co-founder of VestGen, as well as a wealth advisor. Always happy to see you, Craig. It's going to be a while before the Fed lowers interest rates. Inflation is sparking back up, and the Fed's role is to engineer the economy by moving rates to keep prices in check. How far out do you think we are from a Fed rate cut?
And you're correct that the Fed has this dual mandate. They need to create an environment of stable prices and maximize employment, meaning making sure too many people aren't without jobs. That dual mandate is as tough as it's ever been. Add the fact that we have an oil shock, which has created an inflation spike. The Fed's going to remain incredibly data dependent. That means they're not going to be preemptive. They're going to make their decisions based on data. And while sometimes that's criticized, I think it's really important because a data dependent Fed, they're never going to be early. They're oftentimes going to be late, but it leads to the consistency of decisions. And that's what we all want as citizens, as business owners, as investors and traders. But I think we can break it down into a couple key things that people should be considering prior to that October and December meeting taking place later in 26.
What's your advice to investors to get ahead of any moves by the Fed?
Well, I think the number one takeaway is we're likely not going to see a rate decrease, a rate cut until maybe the October or December meeting, if at all. There's a lot of variables that go in. In the meantime, what I want savers to be thinking about is the following. If you have CDs renewing, if you have high yield money markets, this remains last call, because I think we're eventually going to have a series of rate cuts because the Fed's going to focus on the other portion of the dual mandate, which is maximizing employment, which is likely to see some erosion into the future, courtesy of artificial intelligence. So lock in those CD rates now. Part number two, if you're a fixed income investor, you're a bond investor, managing that effective duration. Managing duration is really important. While there's some risk of stagflation here, I think being what I call just below neutral relative to the benchmark makes an awful lot of sense to optimize that total return for fixed income investors.
Any final thoughts, especially as investors are affected by those interest rates?
I think most importantly is this. Interest rates do matter. Interest rates have always mattered. And even though we're dealing with this oil shock, which is an inflation spike, we have to remember that the Fed has not changed. The Fed is still in an easing cycle. They are not in a raising cycle. And let that be the backdrop. Let that be your mantra for decision making, and use this extra time we have of higher rates to make great decisions, both with your savings vehicles and all of the bonds that you use in your portfolio for ballast. If you want to learn more about how to do your bonds better, I encourage you to connect with us online at getretiredstayretired.com. That's getretiredstayretired.com.